A bank reconciliation is the process of matching the balances of a business accounting records for a cash account to the corresponding information on a bank statement. The goal of a bank reconciliation is to find the differences between the two balances and record the changes to the account as appropriate. If an account is so inactive that it does not require periodic bank reconciliation, the accountant ought to question if the account actually needs to exist. It may be better to terminate the account and transfer the residual funds into a more active account. Bank reconciliations should be completed regularly for all bank accounts to ensure that cash records are correct. This prevents excess fees and interests charged on an overdraft and helps to detect fraud after the fact. And then this information can be used to design better controls over the receipts and payment of cash. At minimum, bank reconciliations should be conducted at the end of the month when a bank sends out a statement containing the start of the month balance, the transactions for that month, and the end of the month cash balance. However, it's recommended that the bank reconciliation is done daily based on the month-to-date information provided by the bank and the business, which helps to spot problems immediately. Some key terms are deposit in transit, which is when cash and or checks have been received and recorded by the business but have not yet been recorded in the records of the bank where the entity deposited the funds. An outstanding check has been recorded by the issuing entity but not yet cleared the bank account as a deduction from cash. A not sufficient funds check is when the issuing entity's account does not contain sufficient funds for the check. The entity issuing the check will certainly be charged a fee for having insufficient funds for the check, and the entity wishing to cash the check may also be charged a processing fee. Bank service fees are fees for opening an account and keeping an account with the bank. The first step in a bank reconciliation is to prepare the first part of the statement, which contains the balance per bank statement. So that is balance at the start, any adjustments that are made, and then the additions and deductions such as deposits in transit, outstanding checks, and bank errors. So the second step is that you add the balance per the business's books. So that's what the business's accountants have recorded as the balance for the cash account, and that shows the deductions and additions, NSF charges and checks, check printing charges, interest earned, notes receivable collected by the bank, and errors in the company's cash account, which gives you a final adjusted bank balance. So after adjusting the two balances, they should be an identical amount. That's the idea of a bank reconciliation. The final step is your journal entries, which adjustments which increase cash, you debit the cash account and credit the other account involved, for example, expenses, and adjustments to decrease cash, you debit the other account and credit the cash account. Finally, this is just an example of a bank reconciliation statement, and it shows steps 1 and 2 of what I just explained, which is the cash balance per bank statement and cash balance per depositors records, that's the business, and then the two adjusted cash balances